Teaminvest is an exclusive investment community with over 600 members across Australia and New Zealand. We use our proprietary software and the wisdom of the crowd to analyse companies like business owners, not speculators, to identify wealth winners and avoid capital killers. Our members expect an annual return of a minimum of 15 to 20%, with many of them achieving much more over the 18 years we have been running. At Teaminvest, we're about transferring our knowledge to the next generation of investors. Whether you have been raised with an awareness of investing or whether the family legacy begins with you, our goal is to educate and equip you with the knowledge and tools to build generational wealth.
Welcome to the Emerging Wealth Winners series. In this special three-part series, we're showcasing standout companies and leaders from the Emerging Wealth Winners Conference held in October this year. In today's episode, Ausbiz's Kylie Merritt sits down with Michael Eadie, CFO of Credit Corp, to discuss the company's impressive recovery and growth strategy, especially in the US market. Let's dive into the conversation.
Okay, let's meet Credit Corp. This small cap's core business is debt purchase and collection, where they acquire past due debts from companies like banks and telcos and then work with individuals to repay the outstanding balance. It's had a solid recovery in FY25, largely driven by its business in the US. I asked CFO Michael Eadie what he credits for the turnaround and whether it's sustainable.
Yeah, look, I think it's mostly our US business, but we've gone through a couple of years of significant investment in terms of operational improvement, and that's allowed us to invest more heavily in the market. So in terms of buying books of charged off debts, we've increased our investment in the US, or on track to increase it by about 50%. So it's really the US that's going to drive the next wave of earnings growth. We've also got some new products and some additional diversification in our lending business, but that's probably not going to produce outcomes for a couple more years. So it's the US that's going to do the heavy lifting for the next few years.
So what are the specific kind of market dynamics in the US that's underpinning that?
Yeah, look, the US is a very big market. We're a very small share of the market. We're probably less than 5% of the market. So we have got the opportunity to grow our share without really upsetting the balance of the existing players to any great extent. And I guess most importantly, the market's been in relative equilibrium in terms of supply and pricing. So that's enabled us to sort of confidently sort of grow our investment. So as long as that continues, then yeah, we're very hopeful that we'll be able to sort of see that investment growth in the US, which will drive earnings growth.
And do you see any, specific, opportunities or challenges or headwinds in that market?
Yeah, look, I think our key risk really is the consumer. The US consumer, having sort of seen a step down in consumer outcomes about 2.5 years ago. Ever since then, the US consumer, from our perspective, has been performing solidly. And our outcomes have been very consistent. If we saw the consumer come under strain, I guess, we saw some sort of degradation in the economic position, then that would naturally make it harder for us. The other risk is that we see pricing of debt ledgers. So in the investment side, we see pricing increase as a result of competitors who are trying to grow their share by bidding prices that we regard as uneconomic. So they're the two main risks.
How are you stress testing for, potential unlikely scenarios or likely, however you want to think about it, interest rate increases, unexpected rises in unemployment, and what are the levers that you have at your disposal that you can kind of pull to then mitigate, a decline in collection rates?
Look, in our business, we generally don't sort of try and be economic forecasters. It's not our strength. We generally just look at what the current observed reality is, and we bid pricing based on that. We are carrying a small buffer in the US, so when we're bidding, we are allowing for a small degradation, but it's not a substantial buffer that we're allowing for. But yeah, certainly to the extent we do see the consumer sort of position deteriorate, then we will, be able to probably acquire the forward book or acquire, further ledgers in the future at lower prices. However, we will see, degraded outcomes on the back book. The one advantage we've got is that we do have sort of permanent tenure over these debts. So to the extent we under collect for a period, we can potentially make that up in future periods. But yeah, we will see degraded outcomes on the back book.
So if it's not about forecasting, then is it about the sort of the agility, I suppose, to respond in real time as those conditions are changing?
Yeah, certainly we can respond on what we're bidding, as I say, on new books of ledgers. But once we've locked in a price on an existing purchase, we can't adjust that. So that's one of the inherent risks in our business.
So, you're now operating in different markets. You've got different sets of regulatory obligations. Is the capability, I suppose, that you've developed, here and moving into new markets, is that a moat for you if regulations do change, in that you're able to kind of work with those changes quickly and efficiently?
Yeah, look, I think to some extent, certainly it provides alternative ways for us to deploy capital. So certainly if we find one market pricing shoots up to a level that's uneconomic and we can't deploy a lot of capital, then potentially we can deploy more capital into some other part of our business. So that's part of the strength, I guess, of having a diversified business, having particularly both consumer lending and debt buying in multiple markets. So yeah, absolutely, that diversification is important to mitigate risk. It's something we recognised a long time ago when our business primarily consisted just of domestic Australian and New Zealand debt buying, that wasn't really, that wasn't a sufficiently diversified sort of business, I guess, to be a listed company.
You've got, the US, you've got the UK coming online, you've got, digital credit cards. It increases the complexity of the business. And obviously, you have to be able to manage that while still keeping your ROE at levels where you've said it wants to be. So how do you then think about where you're allocating your capital sort of in?
Yeah, look, it depends on where the opportunity is primarily. So look, we're agnostic as to where we deploy the capital. We see at the moment the greatest opportunities in the US market, in the US debt ledger market, but certainly if conditions change there, then we may consider accelerating, the initiatives we've got, such as the Wizard digital credit card in Australia and the UK. We're intending to sort of commence lending in the UK early in the new year. So we've got the opportunity perhaps to redirect capital to those things. But yeah, at the moment, the US is where we see the most significant opportunity.
Your FY26 guidance, what are the key assumptions underpinning your NPAT sort of guidance, and or are there any primary risks that could hinder you in achieving those?
Yeah, look, most of the growth we're saying will come from the US. So that's sort of, I guess that's the fundamental sort of way of interpreting the guidance. The domestic debt buying earnings have been contracting for some years. We expect to hold them, but we won't see growth this year from that. Consumer lending, there's some growth from the Wallet Wizard book, our long-standing sort of unsecured cash loan product, but we're going to reinvest that in pursuing these growth initiatives such as Wizard and lending in the UK. So it will be the US that will need to produce all of that growth. Now, I guess the same risks that, as we mentioned, the US consumer continuing to sort of perform robustly as what we've seen over the last couple of years, and investment markets remaining in a reasonable equilibrium in the US will be important to us.
In Australia, you would no doubt have seen the private credit sector, some commentary, the cockroaches, etc. If there is a sort of a significant change of regulation that, in that broader private credit market, does that help or hinder you in any way?
Yeah, I'm not sure it'll necessarily make a difference. I mean, private credit has provided quite a bit of capital to our sector in Australia. So to the extent that capital is not available, we'd be relying on other providers sort of stepping into the breach. But given Credit Corp itself doesn't carry high levels of gearing, it wouldn't necessarily have a significant impact for us.
Michael Eadie there from Credit Corp. Andrew, there's a lot riding on the continued success of Credit Corp in the US. What do you think about sort of the challenges and potentially opportunities in that market?
Well, Credit Corp's a company that we've covered since all the way back in 2014. So from that point of view, we've got a long history with it. In fact, for a while there, it did actually earn a Wealth Winner title from our membership before it took some risk and got into a little bit of difficulty with its US expansion. So from our point of view, the US expansion makes sense strategically. The Australian market is only a certain size and they really are the major player here. There's not really a lot they can left to grow in this market. And they did, in a way, have to go somewhere. The challenge that all Australian businesses face, and there are plenty of examples of it, is that the United States is not like Australia as much as we consume the same media. Culturally, we're very different, and business-wise, we're very different. And so from that point of view, there absolutely were challenges and risks for Credit Corp that we've been watching while they moved there. It does look, though, that like after a few years of difficulty, they seem to be getting it right. And from that point of view, if they can get it right in the United States, well, the growth opportunities are clearly stellar because the size of the market is many times the size of anything that they could possibly do in the Australian environment. They've got a very strong, long-running management team, a board that's had a lot of relation with the company for a very long time. And so from that point of view, I think they're very well placed to capitalise. So they're in our emerging wealth winners bucket at the moment because we just want to see that transition successfully to growth in the United States continue. But, you know, on a PE of 11 times with growing earnings, it's starting to look pretty attractive.
Because the recovery that they talk about has really only been evident in the share price in the last sort of 6 months. So how much, you know, we talk about sustainability a lot, but how much more time would you want to see before you start saying, yes, this is a sustainable recovery, it's not a blip?
Well, I think we probably want to see one more year's worth. I mean, realistically, if you actually look at Credit Corp's performance as a business, take out the United States, but just look at it as a whole, as a group, it's roughly double the size in terms of profit now than it was 10 years ago before they embarked upon this journey. So from that point of view, the thing we can judge management on, which is have they grown revenue and profits and done it in an ethical way, they tick all the boxes. The market has a nasty habit of catching up to that very late or running ahead of it very early, because at the end of the day, the market's driven by supply and demand. And a debt buyer in Australia with US exposure is not exactly a sexy thing to talk about at the average conference. I think we're probably one of the only people that would talk about it at an Emerging Wealth Winners conference. It's certainly not as interesting as some of the other names like Drone Shield that we've been speaking about. But therein lies the opportunity for investors, because when others are not looking, that's when you get to buy wonderful businesses at very reasonable prices. And I think the market will take a while to wake up to this, because who's going to ring all their clients and say, hey, go look at a debt buyer? It's not really an interesting phone call to make as a broker. But as a long-term investor, those are wonderful opportunities, because if they can continue to be as stable as they've been, if they can continue to grow out of the United States, there's huge runway here. It's already highly profitable and it's available for a pittance. It's not hard to make money with those combining.
Now we shift focus to the Australian Wealth Advisors Group, or AWAG, a diversified financial services firm making waves through activist investing and industry consolidation. Kylie Merritt speaks with AWAG directors IaFrate and Mark Stephen about their unique approach, their role in reshaping the financial advice landscape, and what's next for the sector. Let's join the conversation.
The Australian Wealth Advisors Group, or AWAG, is a diversified financial services firm operating in funds management, financial wealth management and advisory, and corporate and activist investment. It focuses on leveraging industry rationalisation through participating in M&A through its Armitage Microcap Activist Fund. In this interview, I spoke with two of the WAG directors, IaFrate and Mark Stephen.
So AWAG is the listed parent. It has 3 chapters. The first chapter or division, whichever we want to call it, is our funds management chapter, which is called and trades under the brand of Armitage Private, been operating for well over 30 plus years. The second chapter and division is our wealth advisory financial planning chapter. There are 2 operating divisions there. One is called CHPW, and the second one that we've just recently acquired, taken a stake in, is First Mutual. That gives us a footprint nationally of over 40 advisors. The third, probably the most exciting one, which the market's most keen on, is our corporate activist division. There we take active stakes in listed companies and seek to be a player and a participant in forcing mergers, takeovers and acquisitions. And just as an expansion there, from September 19 through to April 22, there were 13 mergers and takeovers, and WAG participated in 11 of them and made a lot of money for our shareholders and unit investors.
So how do you, under that activist strategy, how do you identify the targets? What's your sort of approach, firstly to finding them and then to initiating that change?
Yep. So what happened after the Hayne Royal Commission, the valuations of listed financial services companies, particularly in the wealth advisory sector, were torched, thrown into the rubbish bin, and wasn't a pretty sight. So value was easy to find. It was extracting the value and getting the consolidation benefits for shareholders. That was the tricky bit. Two into one don't go, because two chairmen into one don't go, two managing directors into one don't go. So our modus is to work with boards once we've got our strategic holdings and with other strategic shareholders in trying to get to a common ground. And the first question is, and the only question is, who is the natural owner of the asset? And once you've identified that, it's pretty easy to then get the parties together.
So is it a people problem that you're solving?
100%. So upwards of 80 to 90% of our research is qualitative. 10, maybe 20% is quantitative. There's the asset, but to get to that asset, you've got to go through people. And people can be selfish, nasty, happy, whatever is possible. And you have to navigate your way through. So WAG is happy to play good cop or bad cop. Our focus is to realise the full potential of that discounted asset for our shareholders and unit investors.
For investors who might not be familiar with your business, what other listed businesses in the financial space would you sort of liken yourselves to?
There is not one listed corporate activist in financial services. We're it.
But that's not all you do.
That's it. There is, in our universe now, there is 6, maybe 7 companies left that are listed that you would classify as wealth advisory and services related to it. There will be the final leg of consolidation is well and truly underway, and we see that those 6 may shrink down to 2, 3, certainly not 4, but certainly 2 or 3. Our function and our role at WAG is to have that occur, to get it down to 2 or 3. And if we're the party last standing and we're able to take over and or merge with the other 4 or 5 that are listed, and so be it. And we are actively pursuing that strategy. Currently, we own 15% of Centrepoint Alliance. It's the 3rd largest listed owner of authorised reps, financial planners, and they are front and centre in the last final leg of consolidation, and we've got a seat at the table. So however way it goes, we're going to be front and centre. We also own 2 other positions just below substantial shareholder level in 2 others that are listed. So however the cookie crumbles, we're going to be sitting at the table.
Okay. Your share price has been moving higher consistently all year. Is that directly linked to FUA FUM, or is it something else?
I think what's happened is we've got a tight share register. It's not an open share register. Well, when I say open share register, when we came to market, we had about 390 shareholders. The bulk of the register is owned 60% by the board. There is no directors' fees paid. There is no directors' emoluments. Every director is working for one thing, and that's the value of the share price. I think the market's now starting to see that. I think the market's now starting to see, with the number of transactions that we've just recently completed, that, hey, gee, these boys are serious. And when we came to market, I said to a few people, we were asked, why did all these old blokes get back together again? And I said, well, we could see that there was one last shot. And so we got the band back together again. And the experience and the knowledge that sits around that board, I'd be shattered to think that there's probably another one that has that level of experience, of success, self-made. There's no corporate junkies that have come out of massive brands. These are all self-made individuals through discipline, and they've written out their cheques to play. And we can all see that this is a golden opportunity. We pinch ourselves and think, how could this be? That the market has now shrunk down to half a dozen listed players that speak for over half of the financial planning advice market in this country. That's where it's shrunk down to. And so it'll never happen again. This is it. As Doc Neeson's once said, this is it, folks, over the top.
Final question, breaking news. This week you've just announced a deal with Phillip Capital. What does that entail?
Well, sometimes it's what you don't read that's important.
What are you going to tell us?
Like I just said, sometimes it's what you don't read is important. Look, Phillip Capital is a multinational financial services brand. It has corporate influences, distribution influences worldwide. They've been in the Australian market on the edges for a while. Maybe they see working with a bunch of old boys like us a smart thing, that these guys know how to get the job done. We see in them a good working relationship going forward. We've got to be very careful. And who is going to end up being the owners of assets in the financial services space in Australia? It'll either be the banks may come back at some stage, or it'll be foreigners. And why? Because the multiple that is available that they would be paying for Australian businesses relative to the multiples that they're paying offshore is peanuts here. They're paying less than a third here in Australia for comparative businesses offshore in Asia and through the Americas and even Europe. And so we have got a very, very attractive model here. It is legislated. It is 12% out of your pay packet comes into a super fund or a compulsory saving somewhere. It is a beautiful honeypot. Everybody wants it, and they're coming after it. And our job is just to package it up and hand it over to someone and say, there you go, here's the present with a nice little bow.
So, Mark, I'll ask you this. AWAG's objective is to sort of actively participate in the rationalisation of the diversified financial services sector. What does that mean?
I guess there's two parts to this. We're looking at the current trends, and I've labelled it supply and demand. So what's happening in the Australian market and financial advice services industry. Around about 2017, 2018, there was something like 28,000 qualified quality advisors. Today, that's arguably around 12,000. And if you remove the likes of part-time advisors, part-time power planners and so on, that figure could be as less than 10,000 quality advisors servicing an ever-expanding need for advice. The second trend is this intergenerational wealth transfer. So in the next decade, we're going to see something like, and research tells us, anywhere between $3.5 to $5.5 trillion worth of investable assets transfer. And if you include the likes of property and collectibles, that figure could be anywhere up to $10 trillion of funds and value being transferred from today's generation to next. Thirdly, there's an increased demand through all of that for personal financial advice, not transactional advice, more that comprehensive personal advice. Something like 10 million Australians today are seeking out and searching for that quality comprehensive advice. Not transactional advice, not robo advice, more so to understand personal circumstances. So you combine those forces together, and I think what Lee mentioned before, which is about the valuation of financial planning businesses here in Australia, are certainly on the improve, and that's why we're seeing the likes of internationals coming into play and looking at acquiring not only Australian financial services licensees, the larger dealer groups,
but individual financial planning firms here in Australia. So it's been our aim since we established AWAG and we listed last year in February, that their main game here is to look at how we can participate in that consolidation and rationalisation. And there's only 5 listed entities in that space. And as Lee mentioned also, we have significant play in that space already.
So how do you solve that problem of demand and not enough supply? Is it, do you want to be in the centre of, re-engaging people into that advice space, seeing the number of advisors go up to 28,000 again? Is that the solution? I mean, there are a lot of people saying that, AI and technology will solve all of this, but...
It will be a small part, only a small part, because deep down, Australians would prefer face-to-face, personal advice and services from their advisor. But back to your question, it is a very, very unfortunate situation where supply and demand don't meet, and we don't necessarily have universities full of students wanting to become financial advisors. Hence, I see that as a combination of efforts and responsibility, and for that matter, a legacy for us here in this industry to make a change in that sense, to build up the presence and reputation of advisors and advice so that it becomes an attractive profession to get to. Now, we're a long way short. We're slowly growing, and I think this sort of next gen professional year students, the number of professional year students is growing, but certainly not to the extent to capture that 28,000 that we had a number of years ago. But we're getting there slowly.
We know that the great wealth transfer is already underway, and you'd assume with only 10,000 quality advisors available to assist people with that transfer, there will be a lot of people who go unadvised, and there will be an awful lot of people who simply can't afford the advice. So where do you see the scales meeting again? In what kind of time frame?
Yeah, it's going to be a longer time frame than what we would like. Certainly the issue of the affordability of advice is a key aspect that is a big challenge for us, because advisors today, there's plenty of supply of clients. There's no shortage of Australians searching for advice. And so it's a real shame that certain Australians may miss out on that opportunity to seek out advice. So again, it's a serious problem. We're getting there slowly, but not fast enough, I guess, to meet demand. So that's an industry issue.
Okay, so you're playing in the space of rationalisation amongst the bigger groups, the ones who are listed. What about all of the small independents? Is there a model there that you look at? Similar, I suppose, to what a Kelly and Partners does in accounting, in that, you can start to mop up a lot of those. Mop up's a terrible term, but, you can start to bring a whole lot of independence into one umbrella group.
Yeah, what we didn't explain today on stage, we also have what's called an equity partnership scheme, where AWAG takes up anything up to, say, a 20% stake in individual financial planning firms. So already we have 6. We have around about 6 in the pipeline of individual advice firms, and some have an accounting connection as well, where AWAG takes up a collaborative capital position to help them grow, expand, make further acquisitions themselves, etc. So we currently have that as on our radar, and as I said, we've got 6 already EPS, equity participation, equity partnership schemes nationwide, and we're looking for further, market presence in that space.
And is this network of advisors that you have stakes in, are involved in the consolidation of, does that become a distribution network for your current and future products?
Certainly, without going down this path of sort of full vertical integration, is not necessarily a key component, but it does help, of course. But it's not a mandatory requirement with the advice firms that we take up in equity partnership, but it does help. As does scale, and again, what I mentioned on stage, which is a benefit of, I guess, this consolidation is this whole leverage, scale, profitability, operating efficiency, all those sorts of benefits come with that consolidation, and that's what we're searching for. As it does, which is the point you mentioned before, as it becomes a go-to place for talent, right? So we're looking for quality advisors to enter our space. If we've got all that in our family, obviously it becomes an attraction for individuals to seek out and become advisors and search for, the right place to be. And hopefully that's with AWAG.
Cool. Thank you very much. Drew, why do you like this company, and why is it different to others in the sector? Because, there's lots of people who are trying to bring different brands under one umbrella. These guys obviously doing it in the activist space, but is that all that sets them apart?
I think the caliber of the people that WAG have assembled is rather stellar. I mean, the guys behind WAG, and I'm sure Mark and Lee have spoken about this plenty, certainly they did at our conference. They are some of the doyens of the industry. And so if there are people whose track record says they can take advantage of this upheaval, merge things together and get a really strong picture out of that for both clients and shareholders, it's the team that Lee, Mark, and Paul and them have assembled at WAG. Obviously, it's a very early listed company, so we can't call it a wealth winner yet. And there is significant execution risk because they are going through trying to do something that is difficult and hasn't yet completed. But I do think their track record speaks for itself. And so from that point of view, if you look at sort of those two parts of being a wealth winner, the company's quantitative metrics have to be great and the qualitative questions around management have to be good. They definitely tick the second box, and that's usually a good precursor to the first box being ticked.
We hope you found today's discussion insightful and inspiring. If you know anyone else who could benefit from hearing this episode, please hit the share button and pass it on. If you'd like to learn more about Teaminvest or our unique investment approach, visit us at teaminvest.com.au. And please don't forget to subscribe to the podcast for more episodes. Until next time, stay informed, stay invested, and keep building wealth.